Thank you for joining us. Make Money Count, a very special edition today because we're talking about the Bank of Canada. This morning, the Bank of Canada handed out 50 basis points of reprieve to our borrowing costs. I want to talk today. First of all, I want to make sense of what 50 basis points means. How does it impact the overnight rate? How does it impact the prime rate? How does it impact your borrowing rate? I want to dispel any notions that the fixed rates aren't going to be impacted. So there was no immediate impact in the fixed rates. I'm going to explain to you why fixed rates are going to get impacted and how they get impacted along the way. Okay. I wrote some notes today because I'm super dialed in. I'm super excited about this. We don't have Justin here, which is okay. He's not feeling well. It's not COVID, but it's something. Okay. I want to talk about the balance between population growth and reducing interest rates because the Bank of Canada keyed in on it today in their messaging, and it's important for us to understand it. I want to talk about revisions, downward revisions, CPI's downward revisions, the Bank of Canada's internal downward revisions. I want to let you in on a little secret as to how the Bank of Canada operates, some information that I've managed to glean from someone behind the scenes that I'm going to share with you. And then I'm going to finish it off and we're going to ask two questions. Number one, could Taylor Swift be responsible for a hike in inflation in the month of November when she arrives in Canada to do concerts in Toronto and Vancouver? And number two, are central bankers in the G7 nations part of the problem or part of the solution? Okay, are you ready to go? In the meantime, I would be remiss if I did not remind you not to subscribe and not to like this video because it's exactly what we need in order for the video to be watched by more people. But here goes. So today, this morning, the Bank of Canada delivered a 50 basis points drop in the overnight rate. Okay, there are so many rates swirling around right now. There is the overnight rate, which is the interest rate that the Bank of Canada utilizes for borrowing and lending and sets for all institutions in Canada. And then there is the prime rate. The prime rate is higher than the overnight rate. There's a buffer priced in there. The banks adopt and adjust the prime rate on a monthly basis. So overnight rate today dropped from 4.25 to 3.75. As a result, the prime rate is going to go from 6.45 to 5.95. So for all intents and purposes, your prime rate, of which the variable rate mortgage is priced off of, is going to go down by 50 basis points. It will now be 5.95%. If you have a variable rate mortgage, hopefully it's prime minus 1. At Cannect right now, we can offer you prime minus 1.2, but the purpose of this is not to sell you on Cannect. Hopefully you're already sold on Cannect. Okay, so Cannect, by the way, if you look up on the Financial Post, who has the lowest interest rate for a 5-year fixed rate mortgage in all of Canada? It's Cannect. Anyways, okay. So we now have a 5.95% prime rate. What is key here is it is going to go lower. Okay. There's a couple quotes like Avery Schenfeld from CIBC. I've wrote a couple of these down. He said right after the 50 basis points, the current 3.75% rate is still extremely restrictive. We expect, barring something completely unforeseen, another 50 basis point drop in December. The Bank of Canada has come out and said that they expect the overnight rate, remember there's prime and the overnight rate, but the overnight rate to be at 2.5% by next year, December. That would mean another 125 basis points lowering. And this is critical to bond yields now. So hear me out. Everybody, including the Bank of Canada, is revising their estimations for where interest rates are going. Everybody. These are the same people that told us there was a new normal. If you follow this podcast, you will remember that the new normal is bullshit. And the new normal, guess what? It was bullshit. And it will prove to be bullshit. We are going to retreat back to an overnight rate of less than 2%. That's more than 175 basis points lower from where we are today. 50 basis points will come in December, and then you better believe we're going to get more than 125 basis points in the calendar year of 2025. Previous to now, everybody, inclusive of so out of the big five banks, some of the banks are kind of more aggressive in their predictions for how much the Bank of Canada is going to release in the form of monetary stimulus into the market through their policy. So like CIBC, I just quoted Avery Schenfeld, were always skewed towards more rate cuts. Scotiabank, less rate cuts. Royal Bank, more conservative than CIBC, but still of the belief that we're going to get more rate cuts. So you can kind of see each of the economists at each of the major banks kind of each has their own position as far as where they lie on this spectrum. The one thing that is consistent is that all of them have been slowly moving more and more towards easing monetary policy. All of the banks and the central bank. When that happens, bond yields get affected. So a bond yield is basically what the market believes money will cost on average for 5 years, taking into account all of the external influences that are going to impact the Bank of Canada's rate, that overnight rate. So the bond market has to digest all of this information, all of the predictions from all the different economists, and then arrive at a rate to provide the consumer. And then the bond yield is used to price a 5-year fixed rate mortgage. So if you remember, we did this podcast last week or the week before where we talked about a Globe and Mail article where it was citing a bunch of people that were saying bond yields are where they are and that's why fixed rates aren't going to move and you should take a fixed rate. Total garbage. Because the more revisions happen, the more downward revisions to forecasts from the Bank of Canada, like we saw in today's report, the more downward revisions that we see from the Canadian economists at the Canadian banks, the more influence that's going to have on bond yields. As of right now, the bond market takes all, you got to think of it as like an AI platform, right? It takes in also two things. You got to think about it as an AI platform. You got to think of it as totally dominated by money. And you got to think of it as slightly bipolar. Remember Howard Marks? I was talking about him like maybe a year ago. Famous investor Howard Marks believes that the market swings irrationally between greed and fear, and you should think of the market as a bipolar individual. So way too happy, way too upset, and overreacting in these kind of micro moments. Right now, what we're dealing with is a bond market that's taking in all of this information, and the information is skewed towards fewer rate hikes. The bond market is skewed towards being more positive, which means fewer rate hikes. But what we're seeing is data being revised downward. What I am seeing as a guy who is dealing with the Canadian consumer on a constant basis is a consumer that has been punished, a consumer that does not have a lot of free capital, a consumer that is very worried. And that consumer is going to need more aggressive rate drops than what is currently being proposed. And when rates move faster than what is proposed, which is what we're already seeing, bond yields will continue to drop, which means 5-year fixed rates are going to continue to drop. If you can imagine it, like a 5-year fixed rate right now is priced off of the idea that the overnight rate is going to hit 2.5 in the end of 2025. But I'm telling you right now, the overnight rate is going to be less than 2% in the end of 2025, which means that your prime rate in Canada, okay, so we're going to call upon this moment again, but in December of 2025, the prime rate in Canada will be below 4%, probably just a hair below 4%. So we're at 5.95 right now. I believe we're going to see 2 percentage points lower, at least between now and the end of 2025. And it's not unreasonable. And the fact that we're seeing all this downward pressure and these downward revisions is going to result in a lower bond yield, at least by 50, maybe by 80 basis points from where we sit right now in the market. Now, the thing we have to worry about the relationship between population growth and interest rates. Because as much as the Bank of Canada, and the Bank of Canada mentioned it today, what did they say? The Bank of Canada said, high interest rates have taken a toll on the Canadian economy. It has avoided a recession, although that's largely thanks to rapid population growth, which has kept the overall economy growing while individuals have tightened. So we're not spending as much money, and population growth has been spiking, so it's artificially inflated the health of our economy. And now, because we can't just tinker with one thing, that's the thing about economics, right? Economics can only really be effectively studied in a bit of a vacuum. And the moment you start introducing all of the actual variables, it becomes a little more difficult. And that's part of the reason why the Bank of Canada has a bit of a difficult task, because the Bank of Canada, and this is from someone that I know that works with the Bank of Canada, but the Bank of Canada utilizes regression analysis in order to predict what is going to happen in the future. And it's very difficult to do it when you have instances like population growth being affected so dramatically by a federal government, right? Like, open the spigot, close the spigot, let a whole bunch of people in, don't let them in, kick them out, bring them back, let them study, don't let them study, open up fake schools, who cares, close the fake schools. But like, all of this influx of population affects the economy. What you want to have in an economy is you want to have a strong economy, not predicated on inflation, on immigration. You want the economy to be strong, and because the economy is strong, you want people to come. People will come if your economy is strong. People are going to want to live in your country. Right now, the growth of Canada and its economy is anemic. So if Canada's economic growth is slow, its population growth should also slow. Those two things should work together in economics. However, in Canada, we had this anemic growth rate for our country, and we were subsidizing it, or we were artificially inflating it by dumping more people in. Now we're going to see population growth come in. Bank of Canada mentioned it in their report too. So we're going to see population growth come in. We're going to see interest rates drop. And we're going to hope, the Bank of Canada is going to hope, we are all going to hope, that the Canadian consumer comes back to the market and starts spending and buying cars and buying houses to revive our economy in the face of declining population growth that will strengthen our economy and hopefully bring back natural immigration that wants to come here for a better opportunity. Right now, there really is no kind of better opportunity because other markets are a better opportunity than this market, as evidenced by the CPI numbers, which are all coming in lower than what was expected. Throw that into the, hey, fixed rate mortgages will go lower, and hey, bond yields will go lower, especially if CPI numbers come in lower than what is expected. Which is why I believe it's totally asinine for anyone to say bond yields are as low as they're ever going to be. Not because if CPI comes in lower like it did last month, and if it's interpreted as a negative, then bond yields are going to drop because the Bank of Canada is going to have to lower rates more. You get it. I know you get it. Okay. So if you take out shelter from September's inflation report, do you know what the CPI number really was? 0.4%. The Bank of Canada's target is 2%. Take shelter out and look at how horrible that CPI number is. That CPI number is why you just saw a 50 basis point drop by the Bank of Canada. It's why you're going to see another 50 basis point drop by the Bank of Canada. The only reason why the Bank of Canada isn't telegraphing to you that you're going to see more drops is because they don't want to startle you. But the CPI number that we saw from September startled me, and it should have startled you too. Okay, what does that mean? It means if we strip out housing, shelter, rents are already falling. Rents are falling because unemployment is rising, because consumer confidence is dropping, because capital expenditures in businesses are falling. Economies are it's all interdependent. If we're going to stick the landing, which is another quote that Tiff Macklin brought up. So two other good quotes. Number one, we are now equally concerned about inflation coming in higher and lower than expected. Bullshit. He's way more worried about it coming in lower. Way more worried. That is going to become very evident in the coming meetings and in the coming months as we see rates drop. Because if it comes in lower, then we're dealing with having to inject more monetary stimulus in order to revive our economy. So if we're going to stick the landing, we have to appropriately use monetary stimulus to incentivize people to get confident and start spending again. But more importantly, we've got to get businesses confident. And that takes a more concerted effort. We've got to get productivity increased. We've got to invest in our country. We have to invest in our infrastructure. We have to invest in the things that will make us more, I'm going to say profitable, but more productive per capita on a go-forward basis. you can see this divergence happening between Canada and the United States. It will only continue to happen if the only instrument we have in Canada to affect change on our economy is smacking interest rates down or whacking them way up again. And then we have a rudderless federal government policy of just bazookaing free money into the economy. It's not going to work. It's just going to get worse and worse. Deficits are going to get worse. Interest costs are going to become more cumbersome for the federal government, which is going to make us less and less able to invest in the things that we need to invest in to make our country more attractive for the right people to come into. So yes, I'm excited because we saw 50 basis points. Yes, I'm excited that we're going to see probably another 225 basis points of movement downwards in the overnight rate and your prime rate, which again means 3.95 on your prime rate. If you can get a 1.2% below prime variable rate mortgage now, because they're not going to be around much longer, that means you'll have a 2.75% variable rate mortgage, which will be amazing, which is also why you don't want to take a 5-year fixed rate right now. Anyways, that's amazing. All these things are great. It's going to stimulate the economy. I think real estate's going to come back. I think things are going to come back. Consumers are going to start spending money again. But do you know how amazing it would be if we had a more long-term plan and how much better we could get this country? How the stinking thinking that we just went through for the last 2 years could be removed and we could start targeting a better growth rate because we're becoming more productive. We ain't there yet. So today's decision and the coming rate drops are great for us. We still have to figure things out for our kids because the next time this happens, it'll be worse than this time. And we kind of know the G7 playbook of throw whatever we need to at it in order to keep the momentum going. But that playbook's going to run out when deficits continue to creep higher and higher and productivity continues to go lower and lower. And keep in mind, right? Like deficits breed less productivity. Right? Deficits mean you have less money to spend on investing in infrastructure. Deficits also mean you probably wasted too much money floating it out there to too many people that are just kind of sucking off the tit of your country, right? So there is some pain that needs to happen in order to redirect things and in order to get to a more productive point in the future. Okay, now let's lighten it up a little bit. The one cool thing that I read in all the articles that I've been reading over the last little bit is the Taylor Swift impact. Now, I am not going to the Taylor Swift concert. Maybe you are, and maybe you feel obligated to brag about it in the comments below. I don't know why, but maybe you do. But Taylor Swift has an economic impact such that some economists are even saying that the November CPI number is going to be impacted upwards for Canada because Taylor Swift is coming to do a bunch of concerts, which is just amazing. I found out actually from a buddy of mine that is very involved in that business here in Canada that Rogers actually paid her money to come in because the Rogers Center isn't big enough. Like the Sky Dome isn't big enough for her to hit her minimum. So Rogers gave her cash in addition to bring her to Canada and then split the concerts up between Toronto and Vancouver. So I guess way to go, Rogers. You're no friend of mine though, Rogers. Remember that. I'm moving my cell phone from you because of your oligopolistic behavior. I mean, whatever, it's Canada, right? Cell phones are going to screw us. Banks are going to screw us. Groceries are going to screw us. Maybe somebody could stop at some point. Anyways, the final thing before I go on my oligopoly rant, the final thing is I read a really cool article and it's a total it's a Globe and Mail article, but it was a total kind of attention grabbing thing where they were like, are the G7 central bankers part of the solution or part of the problem? And it was like clickbaity because it was totally written by this G7 cabal strategy of no, without the central bankers, we would be nowhere. And they're so great and they're so smart. I think I disagree. I think that I don't think these people aren't smart, but I think that when too many smart people get into a room, it's very easy for all of those people to share one idea. And if they're all already aligned because they have been kind of groomed to be in that room, right? Like if you're a central banker, you are selected. And if you are selected, it means you are working in concert with government. And if you're working in concert with government, you are aware of social programs and policies and the direction of your predecessors and how things have gone. I think that like introducing some new voices into that room could be helpful. And I know it didn't work very well in Australia. They had like business people as a part of the kind of governing council, and there were leaks and they were trading based on the information. So there's a way that this could be done, and we're not going to go into the strategy of how to do this. I just think that to say that the central bankers and their group think that we're seeing isn't part of the problem is short-sighted. And I think that there's got to be a better way to approach this, because these jumbo rate hikes and cuts aren't it. And that should just be heuristic for you at this point, that using something that is so impactful that like everybody sits around and waits to hear how much, were we going to get 25 today? Were we going to get 75? Were we going to get 50? Everybody was talking about it. And I feel like we should talk about it being like nothing. Like it should be like it moves, kind of basis points. It moves slowly. It's like a living thing, and it's kind of constantly compensating with the economy, and it's more natural because the massive volatility and the jerkiness of which our monetary policy is being employed can't be good. And it's probably one of those things we're only going to find out later. And whoever does figure it out is probably going to get one of the Nobel awards. And it ain't going to be me. And it might be Austin. You don't know. It might be Austin. Don't say it. It's not Austin. For sure, it's not going to be fucking Justin. I can tell you that much. Anyways, thank you for watching. Thank you for listening. No thanks at all for liking or subscribing. And make money count.